Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at the MarketSite studio in Times Square, New York City, we have David Blanchett, Head of Retirement Research at PGIM Defined Contribution Solutions, to discuss how 401k plans need to evolve. David, it's great to have you with us. Welcome to TradeTalks.
Thanks for having me.
What were defined contributions, particularly 401ks, designed to do?
Help people accumulate wealth. In theory, there's been a dramatic shift in how we save for retirement, where in the past you might have a defined benefit plan that kind of makes it easy for you to decumulate your savings. I think today we've had too many plan sponsors that have 401k plans really focus on getting people to retirement and not through retirement.
Well, that's a good point. I mean, people are living longer as well.
Right, and so I think that retirement is really messy. Okay, you don't know how long you're going to live. You don't know what the market's going to do. There's all these uncertainties, and I think 401ks have been pretty effective at getting folks to retirement. But everyone's like, well, now what? Now I've got a plan for 25 or 30 years. I think the question is can employers, can plan sponsors help people stay in the plan and make better choices through retirement?
So how do you think 401k plans need to evolve then?
So I think that they need to more explicitly help people make better choices in retirement. I think one notable gap is just the investments that they offer, right? So if you have a 401k, you probably have a list of 15, 20 funds. You might have target date funds. I'm worried that too many of the funds in these plans, they really aren't focused on wealth decumulation. So there's lots of equity funds. There's not a whole lot of fixed income funds or alternative funds that you really need to build efficient retirement income portfolios. So
what are you looking at, more fixed income and alternative asset classes within a 401k plan?
Yeah, I mean, if you look at a lot of menus, there's only like a cash fund and a core bond fund. And so I think what we need are like long duration bond funds, TIPS funds, high yield funds, alternatives, like commodities, infrastructure, things that really matter when you're building a more conservative portfolio that's designed to create income for life adjusted for inflation.
Do you think some of those aren't offered because perhaps the average 401k investor might not understand how these work? I mean, alternative asset classes are, this is what you do all day long. It kind of makes sense and you can build that plan, but how does, the average person like myself build something that it's going to effectively give me enough income? God willing, I live that long.
That's a really fair point. And a lot of plan sponsors have said, we don't like to offer riskier funds in the plan, for example, with them that may have higher fees because the participants, they don't know what they're doing. And I see that as a valid point. I think that one thing I would say is that a lot of folks today are using default investments, so target date funds, multi-asset funds. If you don't, you don't have to build a portfolio yourself now. You had to maybe 10 years ago before we sold target date funds and plans. But I think one thing that I hear a lot from advisors is that, you need to leave your 401k because you can't build an effective portfolio using the menu of available options. And so I think that there are pros and cons to kind of building out the core menu, but usually what you're going to be adding here are going to be safer options. So if you're adding, bond funds other than long-term bonds, like they tend to be lower risk. So yes, it's a little bit different, but I think what you're looking to do is help someone build a more conservative portfolio that they can use throughout their life cycle versus just accumulate wealth.
Are you starting to see 401k plans evolve?
Yes, there's been a huge shift in plan sponsor preferences. Either they do or they don't want to have participants in plan post-retirement. There has been a huge shift here. And so there's this idea of the retirement tier. What can you do as a plan sponsor to kind of help your participants get retirement ready? One thing is to add, a more holistic suite of investments. You can have access to advice. You could add annuities. There's a whole bunch of things that you can do as a plan sponsor that a lot of plans are just kind of now starting to ask questions about.
I wonder if the workforce is going to start to demand it, because I'll tell you, over the past couple of years, I've had advisors on the show, and clients want alternative assets or other ways to achieve income. So I wonder if it'll become where the consumer demand is there and plans are going to have to follow suit.
So I don't know if it'll come from participant demand because participants don't know what they want often. I think it's really on plan sponsors to ask this question, if I care about my participants when they retire, and some don't and some do, how can I help them most effectively spend down what they've saved? And I think if you're asking that question, it will require changes from this traditional accumulation-focused mindset.
All right, David, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.